Good morning and welcome to another edition of ONV's Financial Podcast. I'm your host today, JJ Foster from Lake City Bank, and I'm joined again by my man, Mr. Sweet T, but I'm going to let him introduce himself today. Go ahead, tell us who you are, Mr. T.
Hi, my name is Terrence Bush. I am a personal banker here from PNC, but all thoughts and opinions are of my own descent. In no way, shape, or form represent me or my employer.
All righty, we got the disclaimer, and Terrence, it is good having you. We understand you had some difficulties getting here this morning. You want to share with the viewing audience what happened? What made this a journey for you this morning?
Well, the thing that made it a particular special journey was the fact that I woke up this morning and my car was broken into. So, kind of sheds a little light on the amount of crime that takes place in the city, especially since it took place while my car was in my drive-through. My driveway. So, yeah, that was a pretty fun experience for the first time.
Okay, perfect. And I'm gonna tie everything together. So, I'd have to think maybe that guy had bad credit. He he went to apply, he tried to get a car, they didn't give it to him. He had bad credit, so he felt he had to take yours. And that's our
Apparently,
topic today. We're gonna talk about credit. And we talked off air, and like I said, I went and pulled our information for the presentations that we do on credit. I had 100 slides that we use in a PowerPoint because credit can go off in all different kind of avenues and everything. And that's why we're going to make this a two-part series as well. But credit at its basics, what is a credit score, Terrence?
a credit score is basically a summary of your financial history from the point where you establish credit to where you currently are in the present. To give a more general understanding of what that is, a credit score is divided amongst three different parts. People typically know them as your TransUnion score, your Equifax, and your Experian. Those three scores come together to give you your actual credit score, which is basically how creditors and lenders view you as responsible when it comes to lending.
All righty. So basically, when I talk to people, I tell them all the time, your credit report is almost like is a resume, right?
Yeah.
Everybody knows what a resume is for a job, but your credit report is your resume to see your lending worthiness.
Yes.
Okay, and now we went over the credit score. What's in the credit report? What can somebody expect when they're looking at a credit report?
Credit report is pretty extensive. It just depends on anything that you're dealing with that's tied to finances, from having credit card debt, from getting mortgages, loans, auto loans, medical bills. Even if you're back on child support and you're not paying that, that can all show up on your credit report. Even if you've had previous bank accounts that weren't in good standing or in bad standing, that all is going to show up on your credit report as well too. As well, anytime you apply for any type of line of credit or any offer of credit, anything like that, all that will show up on your credit report. Bankruptcies, etc. Just the list goes on. It's a very extensive report.
There you go. And the only thing I add too is it has your identifying information is on there, and what you said about the new inquiries is key. A lot of people don't understand.
Right.
You go apply at Lake City, but you've applied at PNC and Chase, and you hit about 4 or 5 other institutions. That shows up on your credit report, and that's one of the things that lender is going to ask. You're going to have to explain those inquiries. So that is good information. When we're talking about credit, and we're going to establish things that you people might want to look into too, is weighing the benefits and the cost and risk of credit before using it. Talk to us a little bit about the benefits of credit, things that people may miss.
Of course. So a big thing that I run into with people that are looking to establish credit or build credit or repair their credit is the understanding. The understanding is the most important part of credit, because you can tell people, oh, hey, well, just start with a secured card. That's a great way for you to build credit. If you don't understand how to use that secured card and how to make the accurate payments to get the card paid off every single month, you're not going to know how to effectively build your credit. The biggest thing is just making sure that they understand what credit is, of course. A way that I like to explain it to people is it's a long term. It's not meant to be a short term. It is a long term goal. So I ask people, well, do you plan on buying a house? Do you plan on buying a nice car? Usually, most people will say yes to those questions. And when it comes down to it, you're going to need that strong credit to be able to obtain those things. Like, we don't live in an economy anymore where you can pay for cash for everything. If you still have a bucket load of cash that you can allocate towards whatever you want, that is great for you. But for everybody else, having a strong credit score is going to be your golden ticket to a better life.
Gotcha. And again, one of the things I explain to people, having strong credit helps you obtain things that are important to you.
Right.
Um, and the other thing, let's talk about one of the biggest influences on credit is your payment track record, paying on time. You get people out there that feel they're paying their bills, and they may be paying it, they're paying it late consistently, thinking they're doing something, not understanding how that's affecting their credit. But if you could just pay a little bit, long as it's paid on time, it's better than paying the full amount late. You want to elaborate on that?
Yes, exactly. So, as we've all seen before, or at least we've all heard of it before, prime example would be when your car is repossessed.
Yeah.
That is the sole explanation of what happens when you don't make a payment or you miss a payment. It same thing that goes for your houses. If you don't pay your mortgage or you don't pay your rent, what happens? They take it away from you. It's not something that you get to keep. You're not entitled to it. The reason that they gave it to you is because you showed that you were responsible enough to maintain it. But once you show that you're unable to maintain those payments, that's where things start to be taken away from you. That's where your credit score starts to take a dip, of course. Now, I know you said about understanding the credit, of course, and how those payments affect it. So if you know that you have to pay your car payment or your mortgage on a specific day of every single month, you either need to be making that payment the day of or before. When you make a payment after, that goes on as you made a late payment. You can get a late fee for that as well too. So why pay more when you can pay on time? It even goes into credit cards as well. When it comes to credit cards, if you know you're supposed to pay your monthly statement on the 23rd of every single month, you need to be either paying it before the 23rd or on the 23rd, to prevent those late payment fees, also to prevent those delinquencies as well too.
Correct. Um, the other thing we can utilize, I mean, is with technology, alerts. Put alerts on your phone. Put
Yes.
alerts on your online bank statements. For those reminders, like you said, to hit those dates um, when you should. Something else people don't utilize is due dates. Call up, that credit card company or something. Try to get your due date changed. If you know you get paid on this week and your credit card is due on the opposite, get it moved to where you can make you can make that payment. Let's talk about balances. People carrying, balances on credit cards. The benefits of paying it off monthly um, versus paying the minimum due that's on that card that people think that that they should pay. Speak to that.
So, as we did discuss before, we did talk about credit cards briefly. Credit cards would be a prime example for this situation as well too. So, when you take a credit card and you use it, of course, I mean, use the bank's money. Don't use your own money, of course. When it comes to carrying a balance over, that's where you start to pay more than what you're actually using. Um, I've heard people say that it's good, healthy to carry a balance over every single month. I've heard people say that it's healthy to pay the card off every single month. Me personally, pay the card off every single month if you can. If you know that you're not going to be able to pay it off every single month, don't spend it unless like it's an absolute emergency. The interest isn't going to kill you, of course, but if you don't like paying interest, I recommend definitely paying the card off every single month. Because what happens is you do get charged interest based off what your APR is or what your annual percentage rate is, depending on what you got approved for. But once you carry a balance over, you're going to keep continuously getting interest on top of that. So if you have a $300 balance on there and you're getting charged interest every single month because you're not paying it off, why are you not paying the card off instead of willingly paying interest?
Exactly right. And I know before we started on air, we talked about we all get these in the mail where they talk about zero balance credit cards. And we talked about benefits of that. You just explained I didn't pay off a credit card, or I've been paying the minimum, so my finance charge is higher than what it should be. So if I get a zero balance and I transfer that over, so for whatever extended amount of time, the 15-month period or whatever it may be, that is to your advantage if you're gonna pay it off. But if you transfer it over there and you just kind of Cadillacing for a better term, not paying it off, it's gonna jump right back and be right where you were at in the same boat. But if you need that little bit of respite from that higher balance, those zero credit cards are a great opportunity. What do you think?
Yeah, that is a great opportunity. Those balance transfer cards, especially if you have another card that you know is maxed out and you're struggling to get the balance to drop down, a balance transfer card is a great solution to that situation. I've done it myself before. It's a great way to save money and lower your payments as well at the same time. Because say you had a credit card with a $5,000 balance on it, okay? The credit card company is expecting you to give them their 5,000 by the end of that month. When you take the balance transfer card, and like you said, 15 to 18 months roughly, that is you taking that 5 grand and dividing it by either 15 or 18. So instead of you having to pay a lump sum at once, you're making small monthly payments without getting interest. So as long as you're making at least a minimum payment, you can still get the card paid off, of course. If you're just making the minimum payment, most likely you're not going to be able to get it paid off before the 15 to 18 month is up. So best case scenario, if you're able to pay more, always pay more. It's going to help you out in the long run, even if you're still getting that interest. If you're able to pay more, go ahead and pay more. Now, with the balance transfer card as well, too, with that 0% interest, it's a great way for you to help save your money as well at the same time, too.
All righty. Now we get off into the length of time, or the type of credit and the length of history. You know, is it better to open up a bunch of credit cards, have them out there with short balances, or is it better to have a couple and I've had a lengthy history with that card? How does that affect the credit?
This is a good one. So, credit linked history. This is a big thing that affects credit. Even if you end up getting a strong score, say like 750 or such, anything like that. If your credit linked history is not extensive, you will still get declined, regardless of what your score is. Unfortunately, that is the sad truth. So when you go out there and you open up a credit card, of course, if they give you a decent balance, that's great. You can use that card whenever you feel like it for everyday purchases if you want to. If you want to go get another one, by all means, you can get another one. But also at the same time, in a sense of longevity, if you get a credit card and you keep it for 4 years and then you turn around and open another one, your average credit length history will drop exponentially because your longest line and your shortest line, they have to get the average of that.
Okay. um, so again, in short, it's better to have a couple credit cards where you had that payment history established. So if I had one or two credit cards and I'm paying them off, like you mentioned earlier, I've established that history. That makes me strong. Versus if I've got five or six credit cards out there and I'm paying a little bit on each balance, that actually would hinder my credit score.
So if you have multiple credit cards, of course, there is nothing wrong with having multiple credit cards if you are able to maintain them in a healthy way, of course. When it gets to the point where you have multiple credit cards that carry multiple balances, I would recommend probably using a balance transfer card, of course. Um, why deal with trying to pay six different people 6 different times when you could potentially consolidate at least 3 to 4 of those cards all into one payment?
Correct. And I'm gonna tie it back into something too that we've talked about past is the relationship with your bank. Get somebody that you trust. If you get, hey, should I open this credit card? Shouldn't I open this credit card? Seek that advice. Um, like I said, tying it back into what we talked about relationships, because again, new inquiries. The more inquiries you have, now you go to get credit to get your house, to get that car, and you got all these all these inquiries from these credit cards that you've opened. So again, I would seek out the advice from your financial institution or somebody that that you trust with your finances. Let's speak to the different reporting agencies that are out there. And the one thing I will say too is the times that we live in now, people are more in tune with their credit and know the reporting agencies. Everybody's got an app on their phone. I literally have people call me and say, "Hey, I want to come see you, but my credit score is at a 640, but I want to get it to a 680. So I think if I pay this off, I've been watching my Experian, and once it jump up, then I'm gonna come see you." Speak to the different agencies that are out there.
Different agencies, as I said before, to reiterate, we do have the TransUnion, we have Equifax, and we have Experian. Those are typically the three primary branches of credit that make up your financial consumer reporting record. Now, when you speak of the three branches particularly, I know for a fact that the Equifax isn't really one that's referenced to majority of the time when people are out doing loans for like mortgages, auto loans, things like that. That is one of the like the soft pulls. So if you're looking to see if you're going to be approved, they typically go based off your Equifax score. They don't actually run your credit for your Equifax score to see if you're going to be, selected for a pre-approval. Now, when you come to do your auto loans and you want to get like the mortgage, or you want to get a personal loan, or you want to get a line of credit, that's where your Experian and your TransUnion will definitely come into play. So making sure that those two scores are strongest will definitely help you out in the long run. Of course, making sure that all of your scores are strong is going to help you out completely, of course. Especially with the inquiries that we talked about. The more inquiries, the lower your credit score will be. They do drop your score based off how many inquiries you do have. And typically, nobody usually tells you this, but those inquiries will stay on your report for about roughly 2 years. So you do have some time before those inquiries do start to fall off. So if you're able to keep that number at least at 5 or below, go ahead and do that, especially if you plan on buying a house or a car sooner in the future. Make sure that your TransUnion score is at least very strong and you have a lowest amount of inquiries as possible, because the more inquiries you have, the more they see that you're just going out there applying. They don't want to see that. They want to see that you trust one person and that you're going to work with that place, not just bouncing around to see who's going to approve you. That's not going to help your score whatsoever.
Exactly right. And I want to add too, when you're applying for a home mortgage, we do a tri-merge. So you take the score of all three and then take that middle score. Um, and again, a lot of people are surprised because they are just like what you just said. They're watching one, you know, that may put you in the ballpark. I've seen some people have been right on it. Some people, it may have been a couple points higher. Some people may have been a couple points lower. But the bottom line, when we make that hard pull, we're pulling all three from the agencies. And again, we use that median score to go from. Um, you touched on inquiry staying on a report for 2 years. What about negative information on a credit bureau? Um,
Like derogatory marks and
correct.
such.
How long? What's the time frame for that?
Ooh, derogatory marks. Typically those don't fall off. You have to call and let them know, to figure out what the situation was to be able to take care of that for that to even potentially fall off your credit report. That's not something that's just gonna fall off after time. It's just like if you get a bankruptcy, like that's something that stays on there for at least 10 years. Like this is something that you're going to be stuck with for a couple of years. That's why I say credit is a long term. It's not something that is short term. Just like if you mess up your credit, of course, you can beat yourself up a little bit about it, but it's a long term thing. Credit's going to be with you your entire life. You can take the time. There are a number of resources out there, people to talk to that can help you repair your credit if you need that as well too.
Yeah, okay. And I was gonna say, I think majority negative information comes off after 7 years, but there are exceptions to some bankruptcies that's on there. And then there's some other things that have no time limit. And I think jobs or salaries of 75,000 or more than 150,000 worth of credit, and life insurance with a face value of over 150,000 or more. Those things, are on there. There's no time limits. Um, and the 7 year reporting rule, people, it gets tricky just because it'll start 180 days after you stop paying on that debt. So again, if you say 7 years, those are things that you have to know. You got anything you could share? Any stories along those lines?
But I do have something to hit back on. So you know how we talked about making those payments on time, right? So as some people are aware, like if you when you're making your payments on time, great, it's gonna help build your credit, it's gonna help lower your loan balance. Now, when you start to miss those payments, or you decide to stop making those payments, that is going to affect your credit immensely. That's where collections start to come in. If you get anything in collections, that's going to stay in collections. You still have to pay that off. Your credit score will suffer. Also, if something goes in collections and you still refuse to make a payment, you can start to get garnished. Will also ruin your credit as well for you. So if you're able to make the payments, definitely make the payments. If you need to contact whoever has your loan or anything like that, definitely call them. They are willing to work with you. If you need to set up a different type of payment plan or even change your payment date, there are a number of options out there for you so that you don't have to let your credit suffer.
And that's great information. The other thing too, medical bills. Medical bills aren't typically on the credit bureau, but if they go unpaid for 180 days, they will hit your credit bureau. And to what Terrence is talking about collections, that's exactly when they show up. And now, you're going to sit in front of a underwriter or talk to a lender, and explain what's going on with that medical bill. Um, Medical bills, you have to understand too, a lot of people, if you go out, they're willing to work with you. They're willing to negotiate, a whole lot easier than any other bill that's out there, set up a payment plan with you. So, um, you want to stay on top of that versus getting into a hole with the medical bills. You have anything on that, sir?
As far as the medical bills, yeah, doctor's office, hospitals, they are willing to work with you in any type of way to come up with a payment plan, come up with how you're gonna make the payments, when you can make the payments, how much you can pay. So there are options out there. If you can, don't ever let anything go to collections. Of course, it's not going to be good for you in the long run. It's something that will follow you around until it is taken care of. So if you have the capability of taking care of it while it's not in collections, do that. Set up a payment plan, work through it. At least you know your score is not going to suffer. But as soon as that goes to collections, it's just going to keep hurting you. It's going to hurt you when you want to get that house that you're dreaming of, or you want to get that new car, or you need a personal loan because you need to make a purchase for something. It's going to prohibit you from doing the things that you want to do, of course. So when things go into collections, half of the times you can't just go back to the original person that you were supposed to pay in the first point. That's when you have to go talk to a credit adjuster. You have to find out who's holding the bill, and you have to find a way to, once again, set up a payment plan with them. But the only difference is you basically went from a green state to a yellow state because you've shown them that you're incapable of making the payments, or you're choosing not to make the payments. Now, it doesn't stop at collections, because it can get to the point where they start to garnish you if you're still choosing not to make these payments, which once again will destroy your credit score.
When we're talking collections and liens, the other thing I'd like to elaborate, a lot of lenders that I know have gone to non-traditional ways of financing people, because you brought up the example of a repossession of a car. There are people that have made mistakes as children, or they got into a bind. Somebody got sick, and the main breadwinner was unable to work. So if that period is documented, lenders can look at that and see, okay, this is what happened. The potential borrower explains themselves. You can look at non-traditional ways to get them financed. Have they been paying their rent on time? Have they been making their car payment? They've reestablished themselves basically. So even though your credit score is only 600, we're still willing to loan you money. But the other thing, one of the issues that we have outside of just that collections is student loans. You know, People fall into the trap of, hey, it's in forbearance. I'm gonna let Terrence tell you what forbearance means. But even though it's been deferred or forbearance, that still means you're on the hook to pay that student loan. And a lot of people don't get that, don't understand it. And I know the president at one point was talking about forgiveness, and there were some people that got forgiven. And again, if you got that documentation, you show it. But if it doesn't say documentation, uh, deferred forbearance means what, Terrence?
Well, in a simple layman's term, basically, there was like, okay, you sign here, you pay later. That's the simplest way to put it. And that's usually what happens. People sign up for these subsidized student loans, or any type of student loans that they can get. They go to school and they graduate and they start to go on with their daily lives. And then they're wondering why 3 months down the road, they're getting the mail talking about you owe us a payment.
That's exactly right. You still owe that money. It still is sitting there, and that's one of the main things when I talk to people. I mention, because even if you're at zero balance at that forbearance, when you come to see me, I'm going to charge you 0.005 half percent to figure out what a monthly payment is going to be. Half percent of that of your balance to figure out what your payment is going to be. So you think it's zero, but no, it could be anywhere from, I mean, if you took out a $50,000 loan, you do the math, you're going to have to owe on that. But it's funny, my train of thought just came back to me where I was going with the liens and the collections. that's the one thing, even when we do our non-traditional financing, that would be the one thing that will hold you back, because a lien or a collection means that you owe somebody else. That puts somebody else in first lien position. So until you would get that cleaned up, lenders wouldn't be willing to do anything with you, because again, they want to be in line should something happen that they get their money. Somebody else would be first in line. That was, the point I'm making. But again, the student loans are something that I have to explain to people, just because a lot of people don't understand that aspect. Now, we talked about credit, and we've been talking good and bad and healthy. What about people that don't have credit? They haven't established anything.
People that don't have credit, of course, at any point in time, you are starting to wonder about credit or have questions about credit. Do your research. Stop into a financial institution. Go pop into any bank or family member or friend. Google. Look up the questions that you may have. Of course, you can always come find us. We're always open to talk about credit or what credit does, a safe way to establish credit. I've run into several instances where people establish credit by taking out a car loan. I strongly advise against that. One, predatory lending, and what that is typically, people that have low knowledge or low credit or bad credit. They take you and they make you feel good about it, and they still will get you approved, but your interest rate is going to murder you and your payments are going to murder you as well. About 2 weeks ago, I spoke to somebody on the phone that wanted to refinance their car loan. They didn't know about secure cards. Nobody ever had a conversation with them about establishing healthy credit, and they ended up with a $700 a month car payment at 23% interest. And of course, she couldn't really afford it, but she really wanted a car. And so, we got to talking about credit. Where's your credit at? Do you have anything in collections, things like that? You come to find out she had a 340. Me being who I am, of course, they would want me to still, apply and see if we could get her. But me having better judgment, I'm like, I wouldn't recommend it. I'm like, I'm sorry, but based off the credit score, the DTI, et cetera, everything that goes into the report, it would be an instant decline because you've established credit in the wrong way. I recommend starting with a secured card. It's a short, easy, maintainable way. Even if you end up deferring from some of the payments, that security deposit that you put down for the secured card, that'll cover the payment. So if you did mess up, you don't have to worry about anything being sent to collections or somebody sending you a bill. Now with a car and you establishing credit, that's something that we call a closed end line of credit. So after that term is up, that term is up.
Yeah. And really, I speak to, our culture and, upbringing. We didn't believe in credit cards. It's paying cash. I pay all my stuff off. Hey, my house is bought and paid for, my car bought and paid for. And then they go to get something, and you can't, because no credit history has been established. So I mean, yeah, you jump to secure cards, and you're exactly right. Secure cards, credit builders, all those things help build. But I'm talking even, financially well off folks that, like I said, pay for everything in cash. I mean, just opening up a simple credit card and paying on a monthly basis helps to establish, that credit history. And that's what we have to understand. And again, I like tying things into what we've talked about in the past, changing the mindset. So it's not about everything cash, cash, cash. Yeah, that is good. But again, understanding your personal with the business, I've got to have some things over here that are on the books. You know how many people I have that have their own business and they're making great money and they're doing well and they're thriving, and then they want to come and see about it, tell you about how much they make. But then when it's time to refinance a home or to purchase a home, um, they looking at you, they're scratching their head, because what they're actually reporting on taxes and matching up to what they're doing with their personal business. So again, it's about handling that business and putting something on paper that when you go to talk to lenders and you want to utilize, financial institutions for funding, you have to have things aligned.
Yeah, and another thing that I've ran into before is I've had people apply for things and not get approved. And they'll ask the question, well, I have money in my account, I don't overdraft my account and things like that. I'm like, that's not what we look for.
Hmm.
Well, I mean, it's something minor that we do look for. If you can maintain your bank account, of course, that's going to help you initially with the loan application process. But when it comes down to it, the main thing that they're always going to focus on is that credit score and that credit length history and how many inquiries you've had. Doesn't matter if you have an overdraft your account. Doesn't matter if you keep $1 million in your savings account. That's not going to get you approved for something.
Hmm. Wow, that's good. I was gonna say, look, we could close on that, but I'm gonna ask, what is a good credit score? We didn't touch on that. What
A
is a
good
good credit
credit
score?
score, to me, I would say at least 700. That is typically the score that will basically qualify you for every single product out there, from HELOCs, mortgages, auto loans, credit cards, things like that. The higher the score, the better your approval odds are. Also, the higher your score and the better credit worthiness you have, the lower your interest rate and payments will be also as well too. So keep that in mind as well too. So if you know you're going to be out there buying a car or buying a house and they're trying to give you interest rates, the stronger your score, the lower your interest rate will be. Also, when it comes back to that and thinking about a good score, I mean, as you see, like when you look on the chart, if you look at your Experian app or you look at Credit Karma, it'll tell you where your score is. It'll say if it needs work or if it's good or if it's excellent, things like that. I would say 700s. That's a great area to be for everybody. Upper 700s is even better, of course. And making sure that you have at least 3 or more years in credit history. Now, when you look at credit history and you say, well, I've had this credit card for 6 years. I'm like, yeah, but you just opened this one 2 months ago. That 6 years is no longer relevant, of course. You would need to keep that card for a couple more years to get that average credit length history up. So if you can keep at least 3 to 5 years on there as an average balance with a decent score, I would say you're great in that scenario.
All right, well, great. Well, look, you touched on everything that I was gonna touch on, and the key component, the higher your credit score, the best you're putting yourself in the best scenario for the lowest interest rate. The higher, you get up, folks may work with you, but again, they're going to tax you for having that higher credit score.
Yeah, great example. Quick example. So it's like when people apply for credit cards. So say you have a 700, most likely you'll probably get a limit of maybe like 1,000 and probably like a decent interest rate. I've had people come apply with 830s, $65,000 limit, lowest interest rate, just because he had a stronger credit score. So credit scores are the key to a better life, like I said before.
There you go. And with that, Terrence, it's been a great discussion with you. And I'm just going to say, let somebody tell you whether it's a good score or a bad score. I mean, we know it's a good score. Like you said, 700. There's programs out there, 700 Club, and that is what we're thriving for. But as I said, there are products out there that folks are willing to work with you. Get with somebody, a paid professional. Let them take a look. Let them talk about where your credit score is at and what you need to do, because they can make a fundamental and an expert opinion on where you're at, what you need to clean up, if they have products that they can still put you in, without the additional higher fees and things, because I know we have some great products, like I said, that are built just for people that, are that little lower fair to poor credit score, and they have some bumps in the road, and they're on their way back to thriving and getting their credit score where it needs to be. So again, get with somebody and talk with them. Hey, until next week when we do part two, I'm JJ Foster signing off with Terrence. Hey, we love you guys out there. Have a great weekend.